1,072 drones. That is not a typo. That is not an estimate. That is the verified count of Iranian drones fired at Gulf states in a single operational barrage. 1,072 drones and 165 ballistic missiles targeted at the UAE alone. Another 97 missiles fired at Kuwait. Strikes on Qatar, strikes on Bahrain, strikes on Oman. 5 countries, 1 barrage. 1 week into a conflict that the US administration said would last 4 weeks. And the markets opened with a verdict on what that means. Gold is at $5,170, up 1.5%. Silver is at $85, up 2.2%. Qatar stocks are down 4.6%. The UAE suspended trading entirely. Oil is up. Options markets across oil, commodities, and agricultural products are experiencing a volatility spike that Bloomberg is describing as an options frenzy. And the Strait of Hormuz, the waterway through which a substantial portion of the world's traded oil flows every single day, is facing active disruption to shipping. This is week 2 of the conflict, and it is not de-escalating, it is widening, it is deepening, and it is hitting infrastructure and civilian targets across a region that contains the energy architecture the global economy depends on. What we are watching right now is not a standard geopolitical risk premium being priced into commodities and safe haven assets. It is a multi-front supply disruption event that is simultaneously hitting energy, liquefied natural gas production, port infrastructure, and global shipping routes, all at the same time, all in the same week. The 1,072 drone figure is the number you need to hold in your mind as you watch this analysis, because that number is not just a military statistic. It is a signal about the scale of operational commitment from the party launching it. And the scale of that commitment tells you something very specific about how long this situation is likely to continue and what it means for every asset class you care about. We are going to work through this methodically, with the verified numbers only, without speculation dressed up as certainty, but with the full weight of analytical attention that a situation of this scope demands. Let's establish the sequence clearly, because the geography and the targets matter as much as the numbers. Iran launched what it called Operation True Promise or FOR. That naming convention alone tells you something. This is the 4th named operational phase of a retaliatory campaign. It is not an improvised response. It is a planned, sequenced escalation with stated objectives and a documented operational structure. The barrage involved 1,072 drones. Of those, 1,001 were intercepted, 71 hit the UAE. Additionally, 165 ballistic missiles were fired at the UAE. Kuwait received 97 missiles. Qatar, Bahrain, and Oman were also struck. Now, let's go through what was hit specifically, because the target selection tells you about the strategic intent. In the UAE, airports and hotels were damaged. The Burj Al Arab, one of the most recognizable buildings in the world, and a symbol of Gulf economic prosperity, was struck. This is not a military target. It is an economic and symbolic one. It signals that civilian and commercial infrastructure is deliberately within the scope of the campaign. In Qatar, LNG production sites at Mesaid and Ras Laffan were halted. Qatar is one of the world's largest exporters of liquefied natural gas. LNG from Qatar flows to Europe, to Asia, to markets that depend on it for heating, for electricity generation, for industrial processes. Halting LNG production at Ras Laffan is not just a regional energy story. It is a global energy story. In Saudi Arabia, the Ras Tanura refinery fire from the previous strike continues to affect operations. The refinery that processes a substantial portion of Saudi crude exports remains compromised. In Oman, the Duqm port was struck despite Oman's attempts at mediation. The fact that a country actively trying to play a neutral diplomatic role still had its infrastructure targeted tells you about the indiscriminate geographic scope of the campaign. And the Strait of Hormuz shipping has been disrupted. That is the sentence that carries the most weight in this entire story. The Strait of Hormuz is not just an important shipping route, it is the bottleneck through which a massive share of globally traded oil and LNG passes every day. Disrupting that strait does not just affect prices, it affects physical availability. Additionally, Kuwait air defenses accidentally downed US F-15s during the engagement. That detail, friendly fire between allied military forces, tells you about the density and confusion of the operational environment in the Gulf right now. This is not a clean, contained military exchange. It is a chaotic, multi-front conflict with multiple actors operating in the same airspace simultaneously. Italy has sent air defense systems to the Gulf. That signals that Western nations beyond the US and Israel are now becoming operationally involved in the theater. The geographic and institutional scope of the conflict is widening with each passing day. Let's go through each asset class using only the verified numbers from today's data. Gold. Gold is at $5,270, up 1.5%. Gold is now held above $5,200 at various points through this escalation cycle and is consolidating at elevated levels. The continued strength at these prices, against a backdrop of a stronger dollar and elevated rates, tells you the structural demand is genuine and persistent. This is not a spike that is fading as the news cycle moves on. It is a sustained elevated floor that keeps getting confirmed with each new phase of the conflict. Silver. Silver is at $85, up 2.2%. Silver's 2.2% move is stronger than gold's 1.5% in this session. That outperformance is worth noting. When silver outperforms gold in a risk-off environment, it sometimes signals that the market is beginning to factor in the industrial supply disruption angle alongside the monetary safe haven angle. LNG plant shutdowns and port disruptions affect industrial production chains. Silver's industrial demand is embedded in those chains. The market may be beginning to price both the monetary and the industrial dimensions of the disruption simultaneously. Oil. Oil is up, with prior sessions showing gains of 5 to 10%, and Brent holding its gains from the 13% spike earlier in the week. The Strait of Hormuz disruption and the LNG production halt in Qatar are keeping supply disruption fears firmly in the price. The options market for oil is experiencing the frenzy that Bloomberg documented. Traders are buying protection against extreme moves in both directions, which tells you that confidence in any specific near-term price direction is low. What is not low is confidence that volatility will remain elevated. Equities. Qatar stocks fell 4.6%. UAE trading was suspended entirely. Those are not small moves. A 4.6% single-day decline in a national equity index is significant under any circumstances. Suspending trading entirely is an extreme measure that exchanges take only when they believe that allowing normal trading to continue would produce disorderly markets. The UAE's decision to suspend trading tells you that the exchange authorities assessed the damage to UAE infrastructure as severe enough that allowing the market to price it in real time would create panic rather than orderly price discovery. That is a meaningful signal about the severity of the physical damage. Global stocks were described as cautious. Equities outside the region were not in free fall, but they were not buying either. The global equity market is watching and waiting, pricing in elevated uncertainty without yet making a definitive directional call on whether this conflict leads to a sustained global growth slowdown. The dollar. The dollar rallied alongside gold. The same dynamic we analyzed in previous sessions is continuing. Short-term safe haven demand for the dollar is winning over the medium-term fiscal pressure for military engagement. Both paper currency safety and hard asset safety are being demanded simultaneously. Options markets. The Bloomberg options frenzy story is one of the most analytically significant data points in this week's coverage. When traders pile into options across oil, corn, and other commodities simultaneously, it signals that they are not confident about direction, but are very confident about volatility. Buying options is buying the right to profit from large moves without knowing which direction the move will be. The surge in options across multiple commodity classes tells you that sophisticated market participants are preparing for extreme outcomes in multiple directions across multiple asset classes at the same time. That is not normal market behavior. That is the behavior of a market that has lost confidence in its ability to forecast the near-term future with any reliability. Most geopolitical risk analysis focuses on events. What happened? What was struck? What the immediate damage assessment is. That is useful, but it is incomplete. The more important analytical question is not what happened. It is what the scale and structure of what happened tells you about what comes next. Iran fired 1,072 drones in a single operational phase. Even accounting for the 1,001 that were intercepted, the sheer operational scale of that launch tells you several things that are directly relevant to how markets should price the ongoing risk. First, it tells you about manufacturing and supply capacity. Launching 1,072 drones requires that those drones exist and were produced over a period of time in anticipation of this deployment. Iran has demonstrated that it has the production capacity and the stockpile to sustain operations at this scale. That means the constraint on future barrages is not inventory. It is strategic decision-making about when and where to deploy what clearly exists in sufficient quantity. Second, it tells you about the interceptor equation. 1,001 drones were intercepted. That represents a massive expenditure of air defense munitions by Gulf states and their allies. Air defense interceptors are not free. They are expensive, complex pieces of military hardware that take time to manufacture and replace. As the campaign continues, the question of whether the defending parties can sustain their interception rate becomes increasingly relevant. The attackers can replenish drones faster and more cheaply than the defenders can replenish interceptors. That asymmetry is a structural feature of this kind of campaign, and it gets more pronounced with each successive phase. Third, the naming convention of Operation True Promise I-4 matters. This is the fourth name phase. It was planned and named before it launched. That means there is an operational framework with additional phases built into it. The question is not whether there are more phases. The question is what Phase 5 looks like and when it is deployed. For gold and silver investors, these three observations have a specific implication. The risk premium embedded in precious metals prices right now is not being maintained by daily news surprises. It is being validated by a structural assessment of the operational capacity and strategic intent of the parties involved. That is a more durable foundation for elevated prices than a temporary spike driven by a single dramatic event. Qatar's LNG production halt deserves specific and extended attention, because it is the element of this week's story that has the most direct and underappreciated connection to global economic conditions outside the immediate conflict zone. Qatar is one of the world's largest producers and exporters of liquefied natural gas. LNG from Qatar supplies Europe, Asia, and other markets that depend on it as a fuel source for electricity generation, industrial heating, and domestic use. The facilities at Mesaieed and Ras Laffan that were halted represent a substantial piece of that production capacity. LNG is not oil. You cannot simply redirect a different supply source to replace it on short notice. LNG requires specialized infrastructure, liquefaction plants, specialized tankers, regasification terminals, at both the production and the receiving end. Disrupting production at Ras Laffan does not just reduce supply. It disrupts a specific and complex supply chain that markets in Europe and Asia have been built around, and that cannot be quickly reconfigured to use alternative sources. Europe in particular has been in the process of reducing its dependence on Russian natural gas and increasing its reliance on LNG from Qatar and other suppliers. A halt in Qatari LNG production at exactly this moment creates energy supply pressure in European markets that have already been stressed by the restructuring of their energy supply chains since 2022. The inflationary implications of an LNG disruption in Europe feed through into European consumer prices, European central bank policy considerations, and European economic growth. This is the channel through which the Gulf conflict becomes a global economic event rather than a regional one. Not just through the oil price, though that matters enormously, but through the LNG supply chain that connects Gulf production directly to energy costs in Europe, in Asia, in every economy that imports natural gas in liquefied form. For gold and silver, the LNG disruption adds another dimension to the inflation protection case. If European and Asian energy costs rise materially because of the Ras Laffan shutdown, the inflationary pressure that gold and silver have been pricing as a Middle East risk becomes a European and Asian inflation reality. That broadens the investor base that has a direct financial interest in holding inflation hedges, and a broader investor base means more sustained demand. The Bloomberg characterization of an options frenzy across oil, corn, and other commodities is worth spending time on because it tells you something important about the state of institutional market confidence right now. Options are financial contracts that give the buyer the right but not the obligation to buy or sell an asset at a specific price before a specific date. They are used for two primary purposes: hedging, protecting an existing position against adverse moves, and speculation, betting on large price moves in a specific direction. When options activity surges across multiple commodity classes simultaneously, it usually indicates that a large number of market participants are simultaneously concluding that the current price range across those commodities is unlikely to persist. They are buying insurance against moves that are larger than what the current spot price implies. The fact that this frenzy is happening across oil and corn together is particularly revealing. Oil and corn are not closely related commodity markets under normal circumstances. They respond to different supply and demand drivers. They have different geographic supply concentrations. They serve different end uses. When options on both spike simultaneously, it is because the common factor driving them is not specific to either commodity. It is a broad macroeconomic and geopolitical stress that is being priced across the entire commodity complex. That common factor is the Gulf conflict's impact on global supply chains, shipping routes, and the general reliability of international trade flows. When shipping in the Strait of Hormuz is disrupted, it does not just affect oil. It affects everything that moves on ships through that waterway, or through connecting routes that traders redirect cargo to when the strait is compromised. Agricultural commodities, industrial components, consumer goods, all of them face elevated freight costs and logistics uncertainty when major shipping routes are disrupted. The options frenzy is the sophisticated investor community saying, "We do not know exactly what happens next, but we are very confident that what happens next will be large, fast, and potentially extreme." That is not a comfortable signal for markets. It is a signal that the people who are paid to manage risk professionally are in a state of elevated uncertainty that they are paying significant premiums to hedge. For gold and silver, the options frenzy is actually a supporting signal. Gold and silver are themselves the natural hedge against the kind of multi-commodity stress that sophisticated players are currently buying options to protect against. The money flowing into commodity options is money seeking protection from the same environment that makes gold and silver attractive. And some of that money will find its way into gold and silver directly as the preferred low volatility havens in a multi-commodity turmoil environment. The Burj Al Arab being struck, airports damaged, hotels hit. These are not military targets. They are civilian and commercial targets. And their inclusion in the target set has specific implications for how markets have to price the duration and scope of this conflict. When a conflict targets civilian and commercial infrastructure, when the damage is not limited to military assets that can be repaired, replaced, or relocated, it creates a different kind of economic disruption than purely military engagements do. Commercial infrastructure takes longer to repair. The economic consequences of damaged airports, shuttered hotels, and disrupted civilian logistics persist long after the immediate military exchange has concluded. The UAE suspended trading for multiple days. That is a direct economic cost of the civilian damage. Every day that UAE markets are closed is a day of economic uncertainty for businesses, investors, and trading counterparties who depend on those markets functioning normally. The ripple effects of a suspended market: delayed transactions, repriced risk, investors unable to exit positions, create economic friction that is separate from and additional to the direct physical damage. Qatar halted LNG production at commercial industrial sites. Saudi Arabia shut down a commercial refinery. These are not military facilities. They are the commercial and industrial backbone of some of the world's wealthiest economies. And when they are targeted and damaged in active conflict, the message being sent to every other piece of commercial and industrial infrastructure in the region is clear. No asset is off limits. That message has a specific market implication. It means that the risk premium for doing business in the Gulf, for operating facilities there, for maintaining supply chains that run through there, for holding financial assets denominated in Gulf currencies or listed on Gulf exchanges, has risen materially and is not going to come back down quickly, even if the military conflict stabilizes. The physical risk has been demonstrated. It does not need to be demonstrated again to remain priced. For gold and silver, this means the structural floor has another layer of support. Beyond the immediate safe haven demand from the conflict itself, there is now a medium-term repricing of Gulf commercial risk that will keep capital flowing toward assets outside the conflict zone. Gold and silver, which exist outside any specific geography and carry no counterparty risk from any regional political entity, are natural beneficiaries of that repricing. We introduced the stagflation framework in the previous analysis. It is worth updating it with this week as additional data points because the picture has gotten more concerning, not less. The stagflation scenario requires two simultaneous conditions: rising inflation and slowing economic growth. Let's assess where each of those stands after week 2. On the inflation side, the inputs are accumulating. Oil prices remain elevated with prior session gains of 5 to 10%, and Brent holding above multi-year highs. LNG production in Qatar has been halted, adding energy supply pressure that will feed through into natural gas prices in Europe and Asia. Gulf shipping disruptions are adding freight costs across multiple commodity and goods categories. Options on agricultural commodities like corn are spiking, which signals concern about food supply chains that move through disrupted logistics corridors. Every one of those inputs is inflationary. They do not cancel each other out. They compound. On the economic growth side, the picture is also deteriorating. UAE market suspended trading, a direct indicator of economic disruption. Qatar's LNG shutdown removes a significant source of export revenue and economic activity from one of the region's wealthiest economies. Gulf equity markets are falling sharply, reducing the wealth effect and the investment capacity of regional investors. Global stocks are cautious. If this caution translates into reduced corporate investment, reduced consumer spending, and tightening financial conditions, the growth slowdown component of the stagflation scenario becomes more real with each passing week. The Federal Reserve is watching all of this against a backdrop of already elevated inflation concerns and an explicitly hawkish stance from its January minutes. A Fed that was already saying no rush on rate cuts is now watching oil prices elevated by double-digit percentage moves, LNG supply disruptions, and commodity options markets pricing extreme volatility. The inflationary pressure from the Gulf conflict is exactly the kind of pressure that gives a hawkish Fed more justification for holding rates higher for longer. Higher rates for longer slow economic growth further. That reinforces the growth slowdown component of the stagflation scenario, even as the energy price component reinforces the inflation side. The two forces that define stagflation are both strengthening simultaneously in week 2 of this conflict. That is the macro environment in which gold at $5,170 and silver at $85 are trading. Not a frothy, speculative environment. A fundamentally supported environment where the assets that perform best in stagflation, the non-yielding stores of value with no counterparty risk, are attracting exactly the kind of capital flows you would expect them to attract. We are heading into week 3 of a conflict that President Trump described as having a 4-week timeline. We are now halfway through that stated timeline, and the situation has not stabilized. It has widened. The honest investor framework for this moment is the same one we have outlined throughout this series. There is a structural floor under gold and silver that exists independently of the geopolitical premium. And there is a geopolitical premium on top of that floor that fluctuates with the news flow and the conflict's trajectory. What week 2 has done is raise the estimate for how large the geopolitical premium is and how long it is likely to persist. At the start of this conflict, it was reasonable to model the premium as temporary, as an event-driven spike that would begin to release as soon as the situation started to stabilize. After week 2, with LNG production halted, Strait of Hormuz shipping disrupted, 5 Gulf countries simultaneously under attack, and options markets pricing sustained multi-commodity volatility, the premium looks less temporary and more structural. That does not mean it will never release. All premiums eventually release as situations resolve. But the conditions that would cause the premium to release, a credible ceasefire, a diplomatic framework, a stabilization of energy infrastructure, are not visible on the current horizon, and as long as they are not visible, the premium remains embedded in prices. For investors who entered precious metals positions earlier in this cycle at lower prices, the relevant question is whether the current elevated prices still represent an appropriate position size given their long-term thesis. For investors who have not yet established positions, the entry point question is complicated by the premium. Buying gold at $5,170 means buying both the structural floor and the geopolitical premium. If the conflict resolves faster than the current trajectory suggests, some of that premium comes out. If it continues on the current trajectory, the premium may grow further. There's no clean answer. There rarely is in the middle of an active conflict that is widening rather than contracting. The honest position is to know which part of your thesis you are buying and to size your position accordingly. Closing thought. 1,072 drones. 5 countries simultaneously under attack. LNG production halted in Qatar. The Strait of Hormuz disrupted. The Burj Al Arab struck. UAE market suspended. Qatar stocks down 4.6%. Gold at $5,170. Silver at $85. An options frenzy across oil, corn, and commodity markets. And week 2 of a conflict that was supposed to last 4. Here is the cautious, forward-looking observation this moment deserves. The trajectory of this conflict through its first 2 weeks has been consistent in one direction. Each phase has been larger than the last. Each barrage has been more geographically widespread than the previous one. Each set of targets has included infrastructure that was not hit in the prior phase. The operational naming convention, True Promise I-4, implies that additional phases exist in the planning framework. If this trajectory continues into week 3 and week 4, the economic consequences that are currently being priced as risks become realities. The LNG disruption that is currently a supply shock becomes a sustained shortage. The shipping disruption that is currently elevated freight costs becomes a genuine global trade flow problem. The oil price elevation that is currently feeding inflation forecasts begins showing up in actual inflation data. When risks become realities, the market response shifts from pricing probabilities to pricing facts. And pricing facts in a stagflation environment is a different and more sustained process than pricing probabilities. The options markets are already preparing for that possibility. The traders buying options across oil and corn right now are not betting on a specific outcome. They are buying the right to profit from whatever extreme outcome materializes. That is the behavior of a market that has accepted that the range of possible near-term outcomes is too wide to confidently predict, but too consequential to leave unhedged. Gold and silver in that environment are not just a hedge. They are the assets that exist outside the system that is under stress. They carry no exposure to Gulf politics, to LNG supply chains, to Strait of Hormuz shipping, or to the fiscal cost of a widening military engagement. They simply hold value. And in a week, when 5 countries were simultaneously struck by 1,072 drones, holding value is an extraordinarily valuable property.